To understand the full context of the problem, let's start with a very brief movie in 3 acts. Act 1. September 18th, 2025. OpenAI officially signs a $300 billion deal with Oracle to supply essential computing power for its advanced AI. Oracle's stock absolutely skyrockets by a significant third, and its owner, Larry Ellison, impressively overtakes Elon Musk for a fleeting half a day on the list of the world's richest people. Act 2 truly begins. On that same September 18, 2025, Oracle signs a crucial agreement with NVIDIA to supply advanced chips for the very infrastructure of computing power for OpenAI. This deal is initially worth $40 billion, with the substantial potential to increase to $300 billion. The stock rises again. The market is optimistic, and Act 3 unfolds. On September 22nd, in the year 2025, NVIDIA officially announces significant investments in OpenAI, ranging from $50 to $60 billion per gigawatt of capacity, with the substantial potential to reach $300 to $500 billion. That's precisely when investors truly start scratching their heads in confusion. Once again, for those who perhaps didn't quite grasp it, first, OpenAI thoughtfully makes a significant deal for money with Oracle. Then Oracle subsequently passes that substantial money to NVIDIA. And in the end, NVIDIA promptly returns the original funds directly to OpenAI. In the process, the stocks of all 3 companies go up because regular investors, seeing the flashy headlines, invest while NVIDIA, OpenAI, and Oracle quietly sell their shares, making real profits. Once again, the profit doesn't come from their own products. No one has actually done anything yet. $300 billion was simply moved through different accounts 3 times. The profit came from retail investors who bought the stocks. And if you replace the names of the corporations with people's names and instead of OpenAI put, say, Sergey Mavrodi, it's clearly a financial pyramid where no one has produced or done anything. The money was just circulated internally. And all the earnings come from so-called hamsters, the small investors who join the system along the way and end up with nothing. This is exactly what the media have been actively writing about in recent months. CNBC, Forbes, Financial Times, everyone except the lazy has published an article about the dangerous bubble inflating in the AI market. And whether that's true or not, we'll figure out in the next couple of minutes. So give a like to this investigative episode and of course share your opinion in the comments. After all, at first glance, it really does look like a quiet nightmare. 80% of the entire US stock market's significant growth in the year 2025 will come directly from artificial intelligence. AI is also responsible for 40% of the country's total GDP growth. That's, just so you know, $1 trillion or $2. An amount equivalent to the GDP of, say, Italy, but generated in less than a year and basically out of thin air. No one has built any data centers yet, and there's not even a hint of a super AI on the horizon. In reality, all this growth is just $300 billion virtual dollars shuffled from one pocket to another, with NVIDIA and OpenAI playing volleyball with them, while millions of people, banks, and organizations have invested real money into this and risk losing it if the bubble bursts. That's why analysts are shouting from every headline about the possible repeat of the dot-com bubble. For those who are young, in short, this happened at the turn of the millennium and unfolded in a scenario painfully similar to the current one. In 1995, when the internet was just gaining popularity, everyone believed it was the future. Netscape, Yahoo, and later Google and PayPal all soared rapidly and started making significant money. A tremendous frenzy then began among eager investors, and literally any company with a .com in its name quickly attracted billions in crucial funding the very moment it went public. And it doesn't matter if it's an underwear company that's going to sell just 3 pairs a week. Everyone has beautiful charts, promises of progress, and insane profits. Specifically, we're talking about the stock market term PE, the market value of a company's shares divided by its annual profit. Roughly speaking, how many years would it take for a company to pay for itself at its current pace? During the dot-com era, the PE ratio for the vast majority of startups soared well above 100. In other words, it would take 100 years to break even, and people invested for the long term counting on explosive profit growth. Strictly speaking, there's nothing wrong with that. After all, that's the essence of the market, to find a diamond that will become profitable later on. Take Tesla, for example. In 2020, its PE ratio was 1,274, meaning it would have to operate until the 4th millennium just to break even. And that's fine. The business is running, revenues are growing, and the PE ratio is gradually dropping. The real question is whether the business will take off and whether revenues will grow. Because last time, around the year 2000, things didn't work out. In March of that year, investors started pulling out of stocks en masse. A crash began, and by 2002, the American stock index had fallen 78% from its peak. The winners were people like Elon Musk, who managed to sell PayPal in time, and other major businessmen. Ordinary people lost out, even those who never traded on the stock market. The stock market is a place where profits go to those in the know, but when there are losses, the banks turn to the government. The government gives out money and then takes it back from people through taxes and rising prices for goods. The film The Big Short describes this scheme perfectly. The last piece of the puzzle you need to know about the dot-com crash of the 2000s is the role Cisco played in it. While PayPal and Google attracted investors with their products, Cisco was building the foundation of the internet. The company produced routers, switches, and the networking equipment necessary for the internet's growth. You know the saying that during a gold rush you shouldn't look for gold but sell shovels? That's exactly about Cisco. They were the ones selling the shovels, and by the year 2000 had become the largest corporation in the world by market capitalization. And then they crashed louder than anyone else. And now this is where we move to the present day. Today, the role of the shovel seller is played by NVIDIA, which is essentially a monopoly in the AI chip market. The role of the locomotive that needs these shovels is played by AI startups, first and foremost the most hyped one, OpenAI. Its valuation is already estimated at $500 billion. And NVIDIA itself is now the most valuable corporation on the planet with a valuation of $4.5 trillion. If NVIDIA were considered a country, it would impressively rank as the fourth largest in the entire world by GDP, right on Germany's heels economically speaking. Which, you have to admit, is pretty strange for a corporation with only 36,000 employees. That's why investors are getting dot-com crash vibes. But there are counter-arguments as well. As of October 2025, NVIDIA's current PE ratio is only 53. When compared to companies like Cisco, and especially a high-growth company such as Tesla, that's practically nothing at all. On the other hand, it's easy to see that AI is literally everywhere in our lives. Even grandmothers are using it now, not to mention cars and science. And from a third perspective, this time the AI industry is supported not just by private investors, but by entire governments. It would seem like a crash is impossible, right? Unfortunately, that's not true. Here we go back to the year 2008, when Lehman Brothers, the fourth largest and prominent investment bank in the United States, dramatically collapsed. A catastrophic collapse that also seemed utterly impossible to many observers, since it was widely believed to be backed by the government. But no, the bank fell, and it triggered the biggest crisis in modern history, one that even put the dot-com crash to shame. So in reality, the only difference with government support is that it gives the crisis a chance to be contained, or to grow to a planetary scale. And if you look closely, the concerns don't get any smaller. That very low NVIDIA PE ratio is due to the corporation's high revenues. But let's take a closer look at where those revenues come from. The most well-known part among the general public is gaming graphics cards. However, they account for only 8.7% of NVIDIA's revenues, $11 billion. The lion's share, a truly staggering and defining 88% of NVIDIA's total revenue, comes from a line modestly labeled AI data centers, which specifically means income derived from selling advanced chips and essential equipment to major market players. But wait, this is literally what we started this very episode with. Those very same legendary $300 billion that OpenAI spent at Oracle, which Oracle then returned to NVIDIA and NVIDIA sent back to OpenAI. It's like putting money in your winter jacket, not counting it as an expense, and then finding the jacket in winter and counting the money as income. And considering that you are the owner of the jacket, you can repeat this process endlessly and record any income you want. In short, this is exactly the main criticism analysts have of NVIDIA. NVIDIA bought a stake in OpenAI, owns shares in a dozen other AI startups, and just recently invested in Elon Musk's xAI, which, guess what, spent NVIDIA's investment money on what? That's right, it bought chips from the very same NVIDIA. To put it more simply, in shovels. It's as if a shovel manufacturer owned the land and organized tours there for gold prospectors at their own expense, handing out shovels and only asking for a share of the profits. If something like that happened in the real world, the shovel manufacturer's success would depend on whether the prospectors could actually find anything. That's why you can rule NVIDIA out of the bubble equation. The corporation itself does its best to actively fuel the hype and truly profit from it. But ultimately, the eventual fate of this bubble will depend on whether key players in the AI market can genuinely make money. In fact, that's exactly what happened with Cisco. The corporation didn't go anywhere. It still makes excellent equipment to this day. There's just no more hype. The stock price dropped and now only system administrators know about it. And this is where the real problems begin, because OpenAI's net profit is negative $8 billion in 2025. If during the dot-com bubble at least giants like Google were making money, now that's not even the case. The largest AI startup is still significantly unprofitable, and Sam Altman promises to reach its very first profit no earlier than 2029. Anthropic is currently running at a substantial $2 billion loss. Musk's xAI is $5 billion in debt, and Copilot, Gemini, and Llama are surviving simply because they belong to Microsoft and other major corporations. So even though AI is now in virtually every smartphone, their creators are still surviving by the grace of God and NVIDIA's generous subsidies. Profitability is nowhere in sight for these businesses yet. This is actually quite normal for an emerging market. BYD, founded in 1995, made its first profit in 2003. It took Cattle 4 years to break even, Amazon 9 years, and Tesla, in fact, 17 years. For the AI market, it's a classic story to be in debt at the start. The only difference is that BYD makes cars, Amazon does everything from books to space rockets. And OpenAI makes money from, honestly, who knows what Sam Altman is making money on? Well, aside from subscriptions to ChatGPT, and even that line of business is under threat. Because no matter how many cool paid models you release, there will always be some Asian from DeepSeek who does the same thing for free. Nevertheless, from $6 billion in subscription revenue, OpenAI promises to increase its revenue to $55 billion by 2029. Experts have their doubts considering the abundance of free alternatives and the relative ceiling that neural networks have hit. They already do a great job with video and voiceover, but beyond that, there's a wall. Because if you create a YouTube video with artificial intelligence, you absolutely won't be allowed to monetize it. And on the other hand, the grand dreams of personalized AI advertising remain just that, dreams, because OpenAI is currently being flooded with numerous lawsuits. And aside from subscriptions, it's utter gloom and doom. The main alternative sources of income that OpenAI is forecasting are government contracts and, drumroll, collaborations with Oracle, NVIDIA, and other corporations. In other words, it's just moving money from one pocket to another again. The current problem of the AI market is very best symbolized by a single striking image. Money is literally flowing back and forth. And by October 2025, according to analysts, this way they've inflated a bubble worth $1 trillion. AMD also got deeply involved in this story, promising a significant 10% stake in OpenAI as well. And all of this, according to Wall Street, is clear collusion and a troubling repeat of the 2008 financial story, where major banks were also shuffling risky mortgage loans among themselves and eventually got severely burned. The problem is that the market works both ways. On the one hand, hype can send stocks soaring to the skies and overvalue them, but on the other hand, in the event of a downturn, stock prices can drop to embarrassingly low levels. And in that case, it will be tough for everyone. Because in a sense, it would be easier for any taxpayer on the planet if AI didn't turn out to be a bubble and everything went well for the corporations, since otherwise, just like in 2008, it will be teachers and plumbers who end up paying the price. And what do you think? Does the AI industry look like a bubble to you or not? Share your opinion in the comments. That's all from us for now.